You don't vote for them. You don't see their names on ballots. But they own your house, your job, your data, and sometimes even your politicians. They don't build anything, sell anything, or create anything. They move money, and somehow that makes them more powerful than presidents. Because in modern America, money doesn't just talk, it governs. Welcome to a world where money, power, and history collide. And nothing is ever as simple as it looks. Most people have heard the term hedge fund, but few really know what it means. The name itself sounds like something between a legal loophole and a landscaping service. But behind it lies one of the most powerful ideas in modern finance. A hedge fund is at its core a private investment club for the rich. It's a pool of money collected from wealthy investors, pension funds, and corporations, managed by a small team with one mission: make as much profit as possible using any strategy the law allows. Unlike regular investment funds, which have strict rules about what they can and can't do, hedge funds are nearly unregulated. A mutual fund, the kind ordinary people buy through their bank, must play by the rules. It can't take extreme risks. It must report its holdings publicly. It's like driving on a well-marked highway. A hedge fund, on the other hand, drives off-road fast. It borrows money to multiply its bets, buys and sells complicated contracts called derivatives, and even profits when markets crash. A derivative might sound technical, but it's simple. It's a financial bet about the future. You're not buying the actual thing, like oil or a stock. You're betting on what its price will be. It's like gambling on whether it will rain next week, except you can trade that bet with other gamblers for real money. And that's where hedge funds thrive in the world of speculation, speed, and secrecy. The first hedge fund wasn't nearly this dangerous. It was founded in 1949 by Alfred Winslow Jones, a quiet sociologist who just wanted to reduce risk. His idea was simple: buy some stocks he thought would rise and bet against others he thought would fall. But how do you profit when a stock goes down? You borrow it. Here's how that works. You borrow a share of a company from your broker. Say it's worth $100. You immediately sell that borrowed share for the same 100. Later, if the price drops to 60, you buy it back at the lower price. Return the share to your broker and keep the $40 difference as profit. But if the price goes up instead, say to 120, you still have to buy it back to return it, and you lose money. It's legal, common, and risky because your potential loss is unlimited. The stock can keep rising forever. Jones used that technique to hedge his bets, protect his portfolio from market swings. It was cautious, clever, almost academic. But decades later, that same idea would evolve into something very different: an industry built not on caution, but on leverage, secrecy, and power. By the 1980s, America had entered the era of financial deregulation. Reagan's government loosened the rules. The Federal Reserve cut inflation, and Wall Street was flooded with cheap debt. Suddenly, anyone who could borrow could amplify their bets, and hedge funds were built for exactly that. They weren't banks, so they didn't need banking licenses. They weren't public companies, so they didn't need to disclose much. They operated in a gray zone, invisible to most regulators, but deeply embedded in the financial system. If a normal investor is playing chess, hedge funds are playing poker with other people's chips at a table the public doesn't even know exists. By the 1990s, their influence had exploded. They traded currencies, bonds, stocks, commodities, even countries. When a hedge fund called Quantum, led by George Soros, bet against the British pound in 1992, the entire Bank of England lost. Soros made over $1 billion in 1 week. One private investor moved to national currency. That's not a market player, that's an empire. Then came the warning shot, long-term capital management, or LTCM. Founded by Nobel Prize-winning economists in the 1990s, it was the ultimate hedge fund. Using math so advanced it seemed invincible. Its model said crises were statistically impossible until they weren't. In 1998, a Russian debt default triggered a domino effect. LTCM's bets unraveled, and its losses threatened to collapse global markets. The Federal Reserve had to organize a private rescue, $3.6 billion to prevent total contagion. That was the moment hedge funds learned something profound. If you're big enough, the system will save you. Risk was no longer dangerous. It was negotiable. From that point on, hedge funds stopped just playing the markets. They started shaping them. They realized they could influence not only prices, but policy. In the 2000s, hedge funds grew from niche tools for the wealthy into trillion-dollar institutions. They hired former government officials, donated to both political parties, and lobbied for laws that favored complex financial products. Their favorite tools were leverage and derivatives, the financial equivalents of jet fuel and dynamite. With them, a small fund could control billions of dollars in assets. To understand how that works, imagine you have $1 million. You could buy $1 million worth of stocks, or you could use that $1 million as collateral to borrow another $9 million, then buy $10 million worth of stocks instead. If prices rise 10%, you don't make 10%, you make 100%. If prices fall 10%, you lose everything. That's the hedge fund model. High risk, high speed, high reward, powered by other people's money. And when those bets go wrong, the consequences ripple across the economy. In 2008, as America's housing bubble burst, one hedge fund manager, John Paulson, saw the disaster coming. But he didn't just warn people, he built a product that would pay off. When mortgages failed, he made $20 billion in profit while millions lost their homes. That was the same year the financial system collapsed. Yet, hedge funds walked away richer than ever. The message was clear. You can short the American dream itself and win. After 2008, the banks that caused the crisis were reined in with new regulations. But hedge funds, being private, largely escaped those rules. They filled the void, becoming lenders, landlords, and lobbyists all at once. They started buying homes at foreclosure auctions, entire neighborhoods at a time. They turned suburban houses into corporate rental portfolios. By the 22 and 20s, hedge funds and private equity firms owned hundreds of thousands of single-family homes in the U.S. alone. In some cities, 1 out of every 5 rental houses belonged to institutional investors. For ordinary people, that meant one thing: you no longer rent from a person, you rent from a spreadsheet. A computer in New York or London decides how much you pay each month, how quickly your rent goes up, and whether you can stay. And if you try to protest, good luck finding who owns the company. The paperwork leads through shell corporations across 3 states and 2 tax havens. It's not corruption, it's architecture. Because hedge funds don't just own assets, they own structures, legal, political, and financial, designed to extract value from every corner of daily life. After 2008, banks were hit with new regulations, but hedge funds, not tied down by those new rules, saw an opening. They began doing what banks used to do, lending directly to companies, financing takeovers, even funding governments in distress. This became known as private credit, the shadow banking system. In simple terms, imagine your local bank says no to a loan. A hedge fund says yes at double the interest. Because when others pull back, hedge funds rush in. They lend when no one else will, charge higher rates, and often take ownership if the borrower can't repay. By 2024, this private credit market had grown to over $2 trillion, roughly the size of the entire economy of Italy. It's banking without the banks. And it's not just about loans. Hedge funds now influence every major market that touches daily life: energy, food, housing, currencies. During the pandemic of 2020, they made billions shorting the market as it fell, then billions more buying the recovery weeks later. When inflation hit in 2022, they pivoted into commodities: wheat, oil, metals, profiting from scarcity, while households paid more for groceries and gas. They don't just bet on the future, they create it. Because when a hedge fund places a massive position, the market moves, prices shift, policies react. Even central banks pay attention. They have, in effect, replaced regulation with reaction, bending the rules of capitalism through sheer speed and scale. But money alone doesn't explain their control. Influence does. Hedge funds are now some of the most politically connected entities in America. They're among the top donors to both Democrats and Republicans. Their executives attend private retreats with lawmakers. They hire former Treasury officials as advisors. Some even have direct lines to central bankers. This is called the revolving door. When the people who write the rules eventually go work for the ones who profit from them, it's not illegal, it's just effective. You see it everywhere. A regulator retires, joins a hedge fund, and starts lobbying the same agency they once led. The cycle ensures that new laws are crafted not to constrain power, but to stabilize it. And the real genius of hedge funds isn't just that they exploit the rules, it's that they can profit both from stability and chaos. When things are calm, they earn steady returns. When crisis hits, they bet against the world and win again. In that sense, hedge funds have financialized the very idea of disaster. Consider derivatives. Those bets about future prices. They've evolved into markets of their own, trillions of dollars in contracts built on top of other contracts. There are derivatives for weather, interest rates, and even natural disasters. Some hedge funds now issue catastrophe bonds, insurance-linked securities that pay investors high returns as long as a major disaster doesn't happen. If it does, the money goes to pay for damages. In other words, you can literally bet on the climate. To them, risk is just another revenue stream. This logic extends far beyond Wall Street. Hedge funds don't just play markets, they own the data that drives them. They buy satellite images to track oil tankers, thermal sensors to measure factory output, and credit card records to anticipate consumer behavior. They use algorithms trained on millions of data points to predict how you'll spend, vote, or move. It's financial surveillance, perfectly legal, quietly immense. If traditional finance is like reading last quarter's report, hedge fund finance is like reading your mind before you act. That's why some analysts call them the new intelligence agencies of capitalism. They don't need to control governments. They just need to know what governments will do a few seconds before everyone else. And yet, most of their power isn't visible. It's structural. When hedge funds own a significant slice of a country's housing, its corporate debt, its food supply, or its energy infrastructure, they don't need to make threats. Their existence becomes leverage. Try to pass rent control, and capital flows elsewhere. Regulate derivatives too tightly, and liquidity vanishes overnight. Punish speculation, and pension funds, which invest billions in hedge funds, take a hit. The entire system is designed to keep the money moving no matter who suffers when it stops. And the irony, your own retirement fund is probably part of it. Pension funds, endowments, and charities all invest in hedge funds for higher returns. The teachers, nurses, and city workers whose savings depend on those returns are unknowingly funding the very forces driving up housing and commodity prices. That's the hidden loop of modern finance, public money feeding private power. But here's the most unsettling part. Hedge funds don't see themselves as villains. Many see themselves as realists. They'll tell you they're providing liquidity, efficiency, or innovation. They claim they make markets smarter. And in some ways they do. They allocate capital faster, spot inefficiencies, and expose weak businesses. But their success depends on a fundamental truth of history. The concentration of power always accelerates until it breaks. Empires collapse not because they run out of money, but because they run out of balance. We've seen it before. The merchant guilds of Renaissance Venice controlled trade routes until they became more powerful than kings. The East India Company built an empire so vast it ruled entire countries with a private army larger than Britain's own. And now, in the 21st century, the empire isn't built on ships or spices. It's built on leverage and data. Hedge funds are the new trading companies, private sovereigns in a world where capital moves faster than law. They don't raise flags, they raise margins. They don't declare wars, they fund both sides. They don't need to conquer nations, they buy their debt. That's the quiet control of modern America. And while politicians argue about ideology, the real rulers are busy arbitraging it. They fund campaigns, trade policies, and profit from every headline that moves the needle. Because in a system where every crisis can be traded, truth itself becomes just another variable. The danger isn't that hedge funds exist, it's that they become essential, woven into the core of the economy like veins of liquidity. If they vanished tomorrow, markets would seize up. Credit would freeze, governments would panic. That's how deep the dependency runs. So when people ask who really controls America, the answer isn't found in the White House or on Capitol Hill. It's in the quiet offices of Greenwich, Connecticut, in spreadsheets and risk models that decide the fate of nations before breakfast. Empires used to conquer land. Now they conquered liquidity. The tragedy isn't that we lost democracy to corruption. It's that we traded it piece by piece for efficiency until control no longer needed permission. History doesn't repeat, but the pattern is familiar. A new ruling class emerging, not through politics, but through power over debt, data, and desire. And every empire built on leverage eventually learns the same lesson. You can't short the system forever. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to.